TCS kicked off with IT earnings season, beating street expectations in the first quarter. Prashant and Reema sat down with the top management at TCS. Listen in to what they had to say.
Well, that's right. We have the top team at TCS with us to talk about the numbers and, of course, what FY25 now looks like, that we're sort of officially kicked it off with the first quarter numbers. We have K Krithivasan, CEO at TCS. We have Samir Seksaria, CFO at the company. We have Milind Lakkad, who is CHRO at the company. Gentlemen, great to have all of you here, as always. Thank you very much. Krithi, if I could start by asking you, you've always told us two things over the last couple of quarters. One, FY25 is going to be better than FY24. Although you've not put any numbers to it, I hope we can change that today. And second, you said that customers are continuing to prioritize projects with the highest ROI.
That's right.
And they're kind of sort of a little soft on discretionary spends. Just talk to us by sort of giving us your perspective now that we're at the end of the first quarter. You've reported a 2% plus kind of constant currency growth, which is better than what the street was expecting.
Thanks, Prashant. So we are consistent. Okay, FY25 is still whole will be better than FY24,
right?
And we are quite comfortable with that. And see, what we have not been able to see much of a change in customer behavior in this quarter compared to the last quarter. They are looking at cost optimization, opportunity to do more conserve cash, and if there is a continuing trend towards looking at the ROI, so all those none of those factors are changed. And but with that, like you saw our numbers, which we are quite happy about, so we're comfortable with the fact that it will be better than FY24.
So this pickup in growth rate that we've seen in the current quarter, is it because of execution of large deals like BSNL, the typical seasonality, or is it that we are seeing some signs of pickup in discretionary demand? Is that present in the Q1 numbers and the growth rate?
Definitely, like the first point you mentioned, pickup in work in deals like BSNL is definitely one factor. The second is not necessarily the discretionary spend, but more cost optimization spend also. That's as an increase. So both together is what is delivering this.
So there's still no pickup in discretionary demand, or is there any visibility that...
See, like there's no deterioration.
Okay.
But there is no visible pickup to say that now things are back.
So let's nitpick about the 2.2% number a little bit, I mean, if you will allow me. So what, adjusted for the BSNL deal, what would that number be? Because there is a 600 crore increase quarter on quarter in that component, cost of equipment. So what will the, adjusted for that, what will the sort of CC number be?
I will not pick up a project and call it out. But I think if you look at the numbers on the segments which are reported, both from a geography and markets perspective, the growth is very broad-based. When you're looking at sequentially also, if you calculate it, while we don't report the sequential numbers, it is all geographies have been positive growth, and all verticals except one, CMI, which continues to be under pressure, have seen positive sequential growth.
So would it be like close to, I mean, that's almost 1%, right, we're talking about. I mean, if you want to adjust it, you think one should look at it like that? What's the
maths could be here and there, but overall, the 2.2% is there. There are quite a few markets which have grown above the average and at 2%, versus some of the major markets would be around the 1% mark. Okay. Amongst the verticals also, sequentially, at least 2 to 3 verticals sequentially are about 3%, around the 3% mark.
Samir, on margins and the margin performance this time, a couple of questions. One, is there a decline in a reduction in the wage increment that you've given your peers? Is that something that explains the improvement in gross margin? And two, on subcontracting costs, there is a decline. But it's at very low levels now, I think 4.5%. Do you see that increasing, the subcontracting expense? And third one, what can exit margins be? Because typically from Q1 to Q4, you see an acceleration of 2.5% plus or minus. That pegs you with exit margins of 27% plus for FY25.
I hope it was always as easy as that, but let's take it.
Historical number,
let's take each of the questions. So first one was on the wage increments. We had a 170 basis points impact on account of the annual wage increase, which we give typically at the beginning of the year, and as usual we have done that. And in the past, it has ranged between 150 to 200 basis points. So it's bang in the middle of it. So it's a usual impact coming in. Second, on the subcontractor expenses, it's at 4%. Yes, it's been a decline. I'd called it out. We see it bottoming out. I do feel it would bottom out, but it would also depend on how the overall scenario, demand scenario plays out, and how the supply scenario. So typically subcontractor is short-term demand-supply mismatch, and if we need to optimize it, we still have 4% to optimize it. But relatively, as I had called out last time, we would expect it to be stable around this number, but depending on the demand.
Q1, sorry, please.
There was
Exit
one more
margins?
question. Exit margin. Fair. So we are happy with 24.7, and that's 150 basis points, as you rightly called out, from Q1 last year. And I think we have taken the biggest headwind upfront. And last year, our operational discipline and execution rigor ensured we had almost 100 basis points operating margin improvement in each of the quarter. We hope the journey continues.
So
27% plus, is
Saying
it?
that, no, at 24.7, we are glad. We expect, typically we claw back the margins as we go into. It would depend on multiple factors. So
Q1 and Q2 are typically the sort of the strongest kind of quarters. And as Rima said, I mean, through the course of the year, would you be able to? I mean, is there
we
visibility
expect to
for you
claw
to
back margins and move up, inch upwards from here on.
northwards of what? I mean, by.
I hope I had, crystal ball.
But I mean, Krithi, you want to weigh in on that? Yeah.
We've been talking about our aspirational range of 26 to 28. We will try to get back into that range. We don't want to set a target or give a guidance on whether we will reach 27.5. We'll be happy if we can reach there. But our aspirational range will be 26 to 28. So we need to weigh in other business factors and market conditions. So, but we'll continue to.
Is it going to happen from external factors? I mean, levers that you can use in terms of pricing, etc., or is it sort of cost control internally?
Both, right? Like cost control, you can do only so much. So we need to depend on pricing factor also. We look at both options. Like it could be pricing, it could be mix of product, it could be leverage. So many other levers are also with us to manage that.
Milind, the increase in the number of employees by nearly 5,500, is it because freshers typically come in Q1, or is it a sign that, you've had 3 quarters where the employee headcount has declined? Have we come to an end? And what's your prediction or expectation on how attrition pans out from here?
See, I'm very happy that we have 5,400 plus addition. I think it's a combination of both. It's not only freshers, it's freshers and experienced hires both. Going forward, how does it happen? Depends on various factors. We obviously wanted to basically have this number higher, as because we want to basically invest like we all did in the past, right? And campus hiring is something which we will anyway do, and that will anyway happen. That is our core strategy for TCS. So that will happen. So net number, where it will be very difficult to say, but campus hiring will continue.
Okay, and attrition?
Attrition is at 12.1.
No,
which is,
where do you see it headed?
I said 30 basis points. We did 40 basis points. So I expect this to now be stable at this number point.
Krithi, just a quick word on the US, which is of course the big market, the big geography. I just wanted your sense. We speak with economists and market watchers and all of that. I mean, all the time. But I wanted your sense as someone who's operated in that market for such a long time, and you really know what's happening there. Are things getting better, or because we are also hearing that things are actually slowing down very rapidly now? It's under the surface, but it's slowing very rapidly. The commercial mortgage market, for example, etc.
My view, Prashant, it can change from industry to industry also. The interest rate regime is one overhang, elections another overhang. What we understand from our teams is, for instance, telecom vertical, which is stressed for quite some time, which is very capital intensive. With the reducing interest rate regime, maybe there could be more investment that can happen. So it can vary. But other point to look at is, like, while there are enough overhangs there are about new discretionary spend, we also believe there is enough to pick up on cost optimization. We do go to our customers with new propositions on how they can optimize the cost, and it can increase our revenue pie also. So I don't want to depend too much on macroeconomics alone. Like I think there are enough levers outside of the customers still want to do certain things around cost optimization. So we want to go after those opportunities.
Because when we speak with IT analysts, etc., they say, well, the bottom is here. Growth will start to rebound. Maybe it's 1 quarter, 2 quarters out, and that's it. Now we start to,
I don't want to get into this crystal ball gazing at this time.
But do you think we are at the bottom or close to the bottom in that sense, in terms of demand, real demand for services?
I'll be happy if it is true, Prashant. I don't know.
What's your sense? What's your best sense?
That's what I'm saying. I don't want to go by macroeconomic situation. I want to go by what the opportunities out there are.
Okay.
And the opportunities, as I said, like if customers are not spending on discretionary and they are interested in cost optimization, we would love to go to our customers with more propositions around how they can optimize their cost.
You mentioned telecom. Any other sectors which stand out to you, which looks promising?
No, like telecom, I gave an example. Whichever sector is more capital intensive has a immediate impact on the interest rate. Like what happened even on the banking. Earlier days, because of interest rates, they were doing quite well. But over a period of time, the cost of deposit has gone up and the spread has almost vanished. So even now, most banks are going towards fee-based income instead of interest-based income. So it keeps changing over a period of time, because once you live in a particular regime for some time, the whole ecosystem stabilizes around it.
So talking about the opportunity, right? Your TCV, your total contract wins, are slightly lower than what we've had in the prior quarter at $8.3 billion. Is there anything to read in that?
We don't know. We don't read much because we have mentioned many times that our comfort range is 7 to 9 billion.
Okay.
And every now and then you get something lumpy, it goes beyond 10.
Right.
And other thing we look at is what's our overall pipeline. Our pipeline continues to be very healthy. And whatever TCV we declared last quarter, we've been able to replenish in the pipeline. So our pipeline is back to where it was. And there's more a question of timing. The TCV is more a timing question. It always will be lumpy. And any mega deal comes, it will skew it. But
and what's the AI pipeline? I remember last quarter you all shared a number of $900 million.
$1.5 billion.
$1.5 billion.
Yes.
That's a phenomenal growth rate in the AI pipeline.
Yeah.
Okay. And how is the conversion of the AI pipeline into deal? Is that also getting a lot of scrutiny?
We are at this stage. We are doing close to about 270 projects are being executed.
Okay. And in that, is it possible to give us some color on the Gen AI pipeline or the deals that you've executed in
You
value
can do
terms?
that, Rima, but our view and what we have seen in the last couple of months and quarters is more and more projects are getting integrated. Like you are able to get value only when you do a traditional AI along with Gen AI is where you get the value. Pure Gen AI gets a very limited value. So there are data programs that get initiated. There are traditional AI programs that get initiated and Gen AI. So it's a combination. Actually, you're not going to gain much by saying how much is traditional AI, how much is Gen AI. Because we are proposing to our customer an integrated solution on
270 sort of projects essentially. I mean, that amounts to what's the transaction? What's the total value?
We're not publishing the value of those projects.
Okay, but obviously, I mean, the number from last time that we spoke, the pipeline is growing at a very fairly fast clip.
Yeah.
And I mean, any sort of visibility in terms of projections for the pipeline at what is it going to continue with this?
So we are going to our customers with many opportunities, use cases, solutions. So every business unit is doing that. Every geography is doing that. I don't think we are going.
And margins are comparable to this kind of work.
Very comparable. Very comparable
to company averages.
Exactly.
There is a bit of a concern that the Gen AI pipeline or the AI cloud data pipeline is crowd.
I'm including only traditional AI and generative AI when I say.
Is that $1.5 billion?
Yeah.
But I was reading Salesforce, for instance, when they came out with their numbers. So some of the US software companies are talking about reprioritization of tech spends towards AI, cloud, and data. And that might hurt, and that's the analysts in the US are reading it as it might hurt the traditional IT services companies because of crowding out of the budgets because of this. So while it will benefit you, but it'll benefit, say, the hyperscalers a lot more. Is this something that you are seeing?
See, it may benefit, it will benefit them. It will benefit because it benefits us also. Because typically the rule of thumb is if you are doing.
Will it hurt IT service? Will it slow down the growth?
At any point in time, as you spend more on cloud, more on AI, more on Gen AI, there will be less and less spend on the very traditional. But you also look at like you have to move workload from your traditional infrastructure to the cloud. So that's going. We cannot expect people to be working on traditional infrastructure when they are also spending on cloud. Overall, we don't believe it hurts us. It's good for us.
On BFSI, what is the outlook since that's a third of your revenues?
See, we have done, as he was saying, almost all verticals, all geographies had a positive growth this quarter, which is a big relief. And BFSI, I think, is also sort of, North America has done better than, BFSI North America has done better than BFSI Europe. So, which is again is a good thing for us. For a long time, we've been having that was under stress. So North America BFSI doing well is a good thing for us.
Okay.
Any other geographies you want to call out, Krithi, which are
obviously like our overall regional geography has been doing very well. India is doing very well. APAC is doing well. Middle East is doing very well. So the diversification of into regional geographies is playing. Currently now, sum total has become a very material segment for us, and the growth we are seeing is very gratifying.
I'm going to ask you one more time. It's a slightly top-down macro-ish question, but I think that is what really investors want to know. Are we at the, can I put it another way? But my question is, are we at the bottom in terms of tech spending? I don't know if I can ask you this, Samir, because Krithi is not giving us an answer. What's your sense?
See, our focus is, we know our business. Probably the economists can tell better. Our focus is to stay close to our customers.
I'm not talking about macroeconomics. I'm talking about IT spending, spends from IT services, because you talk to clients, you get a sense from them. It's not happening.
See what we are. Let me take what we are. If you ask me what is the tech spend by and large has been flattish. Okay, will it go from here? We need to see. Depends on overall market sentiment. But it's remained flattish for the last couple of quarters, and we are going about our business based on where is the customer wanting to invest and what customer priorities are. So, as I said, like we've been waiting on looking at is the market going to turn up or not for too long. We want to now focus on our customers and see what they want.
Which you've been doing very well, and that's why we are seeing the kind of growth that we've seen. But my only point is that it'll get this tailwind if market sentiment also picks up, and that's my question. Is it picking up? Are we at a point where things start to pick up, or you don't have that visibility yet?
We don't have the visibility. We don't also want to depend on that too much. That's the view we are taking. We know what our customers want. We'll do what our customers
And what about leakage from existing discretionary projects, which was impacting growth? Is that continuing at the same pace, or has it slowed?
No, there is because when they continue to reprioritize. See, what happens is they usually get the low-hanging fruits, right? After that, when the continuing next $10 or 10 million spend happens, they look at is it bringing commensurate benefit. If it's not, they would rather spend that the capital somewhere else, right?
And just one final question from my end. Is this something that you're seeing when you go out and bid for deals? Because some of your peers have lowered the margin threshold. So while you've never had to trade off growth versus margins, but are you seeing some of your peers getting more competitive because margins in the industry have come down? Not for you, but in the industry. So is this something that you're seeing?
It is a competition. See, usually when you are in a low growth environment like this, it is competitive. Okay, people want to grab as much market share as possible. So it is a tough market out there. But you again, as I said, like you go to an existing customer, they know what you can do and what you have done in the past. So you have to provide overall value here to gain the margin as well.